Gentlemen, thanks for joining us. We have quite a few things to go through today about how you built your note fund and everything that you do. Can you introduce yourselves a little bit? Tell us about your backgrounds and how you got in.
Sure. My name is Martin Sines, and I've been an active note investor since 2013, and I've been a real estate investor since '09 on the buy and hold side, which I'm still active in that regard. Now, a little bit about myself. I started my roots with non-performing notes, so essentially distressed debt, buying non-performing notes in the secondary market space and getting those notes to perform. And through the course of evolving my business and building my portfolio, I managed to write a few books on the subject. One book in particular called Note Investing Made Easier, as well as Note Investing Fundamentals. And through that, I managed to kind of gain some spotlight on in terms of what I do and what my company does. So I do speak at conferences around the country on the subject of note investing. And tonight, I'm really excited to be talking about capital raise, especially as it relates to our income fund, Bequest Funds. And so I'm more or less spearheading that side of the fence for Bequest Funds, in addition to my partner, Sean Munyo, who's here with me now, and I'll let him introduce himself.
Thanks, Martin. This is Sean Munyo here. My background is a little different than Martin's. I actually, graduated from college here in Florida. I went to UF and then finished up at University of South Florida here, just north of here, but got into corporate America, climbed the corporate ladder, became an executive in the technology industry, worked for, large Fortune 500 companies in the finance side of the house, selling technology. And I was always a landlord on the weekend. My first commission check I ever got in sales was to buy a duplex, and so built up a real estate portfolio of my own, and left Florida in 2016. Sold all my real estate, moved to Denver, and that's where I met Martin, not in Denver, but through one of the books that he wrote. And so Martin and I connected in 2017. I was his biggest fan, read his book, reached out to him. Martin and I connected, and I became one of his first students in note investing. And here we are, almost 4 years later.
Mm-hmm.
And we now have 3 businesses together. We have a fund, a business that buys non-performing notes, and then another business where we kind of train people the note investing business. And so it's been a great ride. Mark's been a great partner, and excited to be here, Taylor.
Great. Thanks, guys. So much. It speaks to the value of and importance of taking massive action. And I want to just dive into these topics that we lined out today. First off, building a massive action plan for raising capital. We were talking a bit before we kind of started the recording and everything here about that idea of find a deal and the money will follow, find a great deal and the money will follow. And personally, I'm very skeptical of that thought process, that mentality. And how did you build your massive action plan for raising your capital?
So I think it's important to note that the whole notion of drumming up deal flow and raising capital need to be done in parallel. So a lot of the same activities you would do through each of the life cycles for capital raise and deal flow are actually going to be very similar along the path, and both need to be worked equally with a daily focus. So I would kind of put the starting point for anyone, especially on the newer side, to start with one's identity. So what is it you're looking to do in the space that you want to operate in? The asset class you want to buy, what are the buying parameters? What is the level of expertise that you're looking to obtain so that you can be considered an operator or an expert at some point in time? So how you build your identity is going to play into how what type of deal flow you're going to receive as a result, but also the type of capital that you're going to attract. So I would say that's a good starting point for, and why I put it at, building a massive action plan is, if you take the first letters of each word, it's a map. So that's the acronym, is a map. So you're building a roadmap for yourself. And however, after you do the identity, then you need to focus on marketing and branding, but as it relates to how you're going to set your operation up to attract deal flow, but also you're going to attract capital partners as a result. And so when you're at that phase of how you're going to be letting the world know you exist through branding and other measures, I think at that point you need to have legal counsel go and give you some direction, because you don't want to raise capital illegally, and it's very easy to do. So you want to make sure your entity's set up correctly. Your what you can and cannot do is clearly understood. Plus any type of contractual agreements that you have with sellers of the asset class you're engaging with, or with joint venture agreements or what have you that you're going to be using for your capital raise efforts. All that needs to be laid out at the onset. I find that a lot of people kind of do that on the back end, and that's very poor planning, because what you say to someone verbally may change after you talk to your attorney.
Mm-hmm.
And so then you're backtracking, reneging, and all those poor things, when if you just had spoken to a competent SEC attorney or some contractual law attorney up front, then everything you'll say to anyone beyond that point should be in keeping with what you're allowed to do legally. So identity, and then switch into the marketing and branding phase of things. And from that point, that should give you a sense of who you need to research on LinkedIn or using other social media, and who you need to be pouring in outreach efforts towards from a deal flow and capital raise perspective. But both need to be done in parallel, not build it and they will come model, but just both need to be equally worked, because there's going to be a whole balancing act that you'll never get away from. And I'll let Sean.
Yeah, I would just say that the whole identity piece, is a work in process. And, we've been building our identity in the note space for years. Martin came into the space 2013. I came into the community in 2017. And so we've been building our identity for years, and that just doesn't come overnight. We knew exactly what we wanted to do when we launched our first fund, and that was buy mortgages, right? So we were already experts in the space. We had done joint ventures before and raised capital through JV deals. And so just realized that structure wasn't going to work for us as we grew. And so that's when we decided to go to a Reg D 506C fund, which we launched in March of 2020. And so our identity was built. We had built a branding, marketing plan, and then we went right to the structure. But if we didn't have the foundation, we would have failed miserably.
Yeah, just to give you kind of a sense of what we've been up to. So one of our pillars, we buy distressed debt. We've probably purchased around 25 million in the past 12 months of distressed debt. We also, with our income fund operates with a portfolio of performing mortgages. So, we anticipate raising about 10 to 15 million for bequest funds this year. So we'll be active on the performing mortgage purchase side while we still maintain efforts with buying distressed debt. So the whole idea going back to this massive action plan is that one needs to really focus on working out deal flow, not just deal flow, from the outreach perspective, you reach out to different sellers and then they give you different opportunities, but also from an underwriting perspective. So what is your due diligence process? How does that waterfall look? Do you have all the resources set up to, pull title? Do you have competency to read title reports? Are you doing credit pulls? All these various analysis that goes into it, because that's all part of the deal flow acquisition process. And Sean is really active in, instrumental. He runs that whole department. So he buys millions of dollars on an ongoing basis. And he could tell you better than anything about just the whole significance of closing deals and how that plays into the capital raise.
Yeah, Taylor, we kind of talked about how difficult it is to kind of have the two worlds come together and timing to be perfect. And so, I'm constantly, kind of on, looking at Martin's funnel when he's raising capital to see, how much we have to spend, so I can go out to the marketplace and just kind of tap people and say, hey, we're looking to deploy X dollars in the next few months or whatever, do you have a deal? Or I've got to deploy $500,000 this month or whatever. And so, and I know that, 70% of the people that I tap aren't going to have something ready for me. But in fact, 30% of those folks do. And so it's really, I'm always in Martin's office being like, all right, how much capital are we going to raise this month? He's like, too much, get out of my office.
You need to leave now.
You need to leave. But really, it's just so that, I'm inching closer to a deal at the same time he's inching closer to some capital. And it's this dance that we do every day on a daily basis, where somehow at the end of the month, we're both steps away from what we need. And me having a commitment to close on some assets at the same time he's having funds come in, to the account. And it's really, it takes a lot of effort, but each of us need to be focused on, our objective, and that's me finding the next opportunity for us to invest in. That's a profitable deal. That's exactly what our investors signed up for. That's what we sold them, the same type of return and guarantees and, credit risk that we're selling. At the same time, he's bringing those investors in. And so it's not easy, but for us, it's been working well. We've been able to find the capital right now because we do deliver a high yield product that is fairly liquid. And so that's not easy, difficult to find these classes that price. I need them. So, it's quite a dance that we do on a daily basis, but we both have to be focused in order to achieve our objective.
Nice.
So I think the key word that you can take away when you hear Sean speak, he said it about 10 times, and the word is daily. And so you need to have rituals in place whereby you're working all the various inputs that are going to lead you down the road to where you want to go to obtain your goals. And I know probably some of the folks on here may be saying, well, I'm a one-person operation. I see that these guys maybe, you know, Batman, Robin, dynamic duo. He's like, I'm Batman. But anyway, so, you know, but the whole thing is, you know, we have employees, we have a team, we have 7 employees that you know, we lead, and we're hiring more now as we speak. And, you know, all I can say is that if you don't have strategic partners, if you don't have people you can lean on, if you don't have employees, then you need to be thinking, is this for you? I mean, you need to not be cheap. So, I mean, are you know, on one hand, are you looking to build an empire? Are you looking to build this thing out, you know, shoot it to the moon? Then how are you going to do that with just yourself in your basement? So you need to be thinking bigger. You need to be doing making bold moves, pulling the trigger, hire people. You know, people are going to lead you to where you need to be, and people that are committed to the same goals and objectives you have. You know, critically important, and everyone needs to be working their part on a daily basis. And you know, I can't you know, overstate the importance of that, whereby every person on the team, on your team, even if it's just you starting out of the gate, needs to have clear daily metrics by which you're responsible for, and be able to know where you're at any given time. So every day we have morning meetings at 8:05 in the morning. Everyone in our company relays where they're at with their metrics. Everyone's very clear with their goals, and there's no misunderstanding in terms of how each person's goals and metrics work, you know, work with each other, you know, how they all interconnect with each other's goals and metrics to make the company what it is today.
Yeah, and I would just say, you know, Martin and I have both been, if you are, you know, a sole proprietor, you're working, you know, you're trying to build it all by yourself. We've both been there, right? So we know the struggles, and even when we first teamed up, you know, when we got together and decided to hire our first employee, we're like, how are we going to afford this person? And now we're like, you know, we can't afford to be without any of these people here.
Actually, it came with Lauren, it came with me. And
That's right. I brought nothing.
You stole her, brought her into your equation.
I did bring her in. And now she's ours.
Yeah, now she's leading the whole asset management.
She leads, yeah.
But the point is, you know, you need to, you know, one needs to step their game up if you have big lofty goals for yourself, and you need to, your actions need to match those goals. If there's not alignment, then you're gonna stay small. And in this climate where yield's hard to find, deal flow is hard to find, staying small is the kiss of death.
Yeah, and we set a goal this January 1st. We set a goal. Actually, we're working on our goals in December, but we came into January knowing that you know, our fund was going to raise $10 million this year in 2021, which meant that we had to get to work. And so we were working on our plan in 2020, what we were doing in 2021. And that included a massive action plan, where that plan is being put in place right now. And we're on track to raise $10 million this year. When you know, our fund, our first public fund, was just launched in March of last year, and so we raised about $3 million in our first year of operation, and so the goal is to raise about $10 million this year. So raise 3 times what we raised last year. That doesn't happen overnight.
We're at about $1 million this month, so we're definitely on track. The momentum's there. You know, the fund pays 8% annually, and it pays it on a monthly basis to accredited investors. So we're just seeing a lot of activity from the capital raise perspective.
So we know it's a great product, and so you first have to have a great offering. But in order to be able to raise $10 million a year, for us, an entire operation has to be built behind that. And so that's what we've been working on in 2020. That's now been put in place right now, and so everything that we put in place is in fact working.
So a lot of like what we've been talking about has kind of been one-sided. So we've been saying, okay, well, what identity do we want? What kind of effort do we want to put out there? But we haven't talked about the other side of the coin, and that is the profile of the investor that you're looking to attract, because there needs to be alignment that way. You know, as well as alignment, like we talked about with strategic partnerships, with JV partnerships, with employees or 1099 folks. And so, you know, you need to have a clear understanding in terms of what your ideal investor looks like. And, you know, what you know, Sean and I are looking for, just to give you kind of an example, is we want an investor, we would prefer having a non-real estate investor, someone who's, you know, medical doctor, attorney, high income, wage earner, entrepreneur that just has a boatload of money somewhere, is looking for yield because they're in a bank CD or they're scared of the stock market, or they want to diversify from the stock market. So they're looking for our vehicle to provide some stability with their portfolio. And so, you know, real estate investors tend to be high yield seekers, and that's fine. I mean, we're high yield seekers too, so we get that. So, but we understand the identity of our passive investor makeup. And we actually had one person last month. They wanted to put 100,000 in, and we said no. We turned them away, and you know, they just weren't a fit. They were being extremely difficult out of the gate. They wanted us to make a bunch of changes to our model, and because they thought, you know, they knew better than us. So that's the other thing, is that you really have to know, when you know your profile for your investor, then you know who fits in the box, and you should kick out anyone or just you not work with them with that opportunity with those people that don't fit, because it's just going to be a problem down the stretch, even though that dollar looks really good up front.
Yeah, and so we built, you know, before we laid out the fund, you know, we had identified who our target investor was, and so we structured the fund so that it would actually bring in those people. And so, as Martin mentioned, high net worth individual looking for a passive income stream. We knew the asset class we were buying would produce income. We knew that the assets that we're buying were in fact liquid, and so therefore we could offer a liquid product to our investors. We only require a 12-month commitment, which is fairly liquid in the, you know, private placement memorandum world. The world, very in our space. So we knew we had to provide liquidity to our investors. We had to provide income to our investors. We had to provide a decent return to our investors. And so because of that, you know, we knew that our investor would be 55 and older, potentially on the verge of retirement, looking for cash flow. And we built an entire marketing plan around that individual, which meant, you know, our website had to look a particular way, our messaging had to say certain things, the collateral, the content that we created had to speak to certain types of investors. So all of the thought had to go into not just how we brand it, but how the fund was structured and the type of investor who would buy into it.
Yeah, plus expertise, right? So the people that invest with us, they want to know that that we know what we're doing. They want to know about capital preservation and how we're not going to lose their money. So, you know, Sean and I, we put $1 million in our own fund. So we're able to talk as co-investors.
Yep.
We can have the conversation. Hey, I'm not looking to lose $1 million. We're not looking to lose $1 million. We're not going to lose your $100,000. So we can have that conversation about skin in the game. We can have the conversation that, you know, I've worked out over 1,000 loans myself personally. You know, Sean has done hundreds of loans himself, you know, through the course of time. And so we're experts in this space. And that's what people want to understand, the people that want to invest, that look to invest with us. Now, if you're on the newer side, you know, what I would just suggest, you know, Sean was new 4 years ago.
Yeah.
And, you know, you got to do things. You got to give up, you know, more juice, right? More equity, more, you know, kind of how you structure things is not going to be as you know, cut and dry, like a debt-like structure.
Yeah, when I first started out in the note business, you know, the first thing I did was I risked my own capital before I would risk anybody's capital. So I risked my own capital before I went and started raising capital. I had to prove to myself, to create my own confidence that I could do this. And so I put my own money at risk. I generated my own returns with my own capital before I went and raised capital with the folks that I surrounded myself with. And so I did that. I proved to myself that investing in non-performing notes was a good investment before I went and found capital. And so I risked my own capital and proved to myself it worked before I would go out and raise capital from anybody. I think that's table stakes. You need to do that. Wouldn't recommend anybody going to raise capital in a space that they're not well versed in. So I mean, I think that's, you know, the basics.
Yeah, I think that's well said. When I came out, I self-funded for a while. For about 4 years, I self-funded all my deals. But you know, on that side of the fence, you know, Sean fast-tracked things much better than myself. I stayed small for too long. You know, I self-funded. I thought I was that guy, or, you know, that person that just goes out and they're just going to do it all themselves. They're not going to owe anyone any money. And I didn't use debt. You know, I didn't use the leverage that I could have accelerated my growth much more than I did. However, you know, it allowed me to really just learn the craft much more so. So I keep telling myself that. I feel better. but I could have made a lot more money because notes were much cheaper back then. But anyway, so here we are. You know, I can just say that I think a lot of this with the note journey just translates over to real estate too.
Yeah.
Right. I mean, deal flow is what's interesting with deal flow. We have no issue with deal flow. I mean, we have an abundance of deal flow opportunities, but it's because we transact so much. So it's kind of like that thing, right? That gotcha, you know, catch-22. So if you want an abundance of deal flow, then you need to transact on a lot of deal flow.
But it's like the chicken before the egg.
Yeah.
Right? Like
Yeah.
you're telling me to transact more to gain deal flow, but I can't find my first transaction.
Well, yeah. But there's an answer to that, and that is where, you know, I said it was cyclical, right? This massive action plan. It's not linear. So a lot of people work things like a tired rehabber. They work in a linear fashion, right? They go out, expend energy and some money, and they go find a property. And then everything stops, right? They celebrate, and then they start working on the property. And then they're tired. And then they get the property prepped, ready to resell. And then they get paid and they're happy again. And then they go out and they want to duplicate that process. I think the Burr model or whatever that's, you know, tossed around, but that's the wrong approach, because you should be focused on deal flow all the while. as you're working on the process, as you're working out that asset, you should be working on deal flow. And on both the capital raise and the deal flow cycle. So you're working them in parallel. So it's almost like a matrix kind of thing, right? You're kind of working, it's like a spider web of activity.
Sounds like a lot of stress.
Yeah, but if you're not doing that, you're not
Exactly.
gonna scale. You're not gonna scale. And that's the thing, because you're just gonna be tired at the end of the day. You're gonna be working that asset while no outreach is going on from the deal flow or capital raise perspective. And because you're gonna do that later, after you get through this 1 or 2 projects and repeat, but everything needs to be working at the same time.
But we're experts in acquisition and raising capital because we've chose to do them both simultaneously and not stop, and work really hard. And so for us, you know, there's no other way. There's no other way to be successful and not do both simultaneously, which required Martin to clone himself and me.
Yeah,
Better
a better version.
Upgraded version.
Yeah, there you go.
Younger,
we have to feed,
stronger.
Yeah, we have to feed that head of yours. But but anyway, like if Sean went and decided to stop the acquisition team, the acquisition effort, if he just said, he told these sellers that we've been transacting with for years, he's like, hey, you know what, I gotta put the brakes on for 3-4 months. I need a cool off period so I can go work through the assets I have, then his phone would ring a lot less and he would lose momentum. And momentum is everything.
Everything. Yeah, absolutely. And so we transact through a lot of brokers, and so I think every real estate business is in the same way, right? There's a lot of brokers out there that, you know, the question is, are they calling you the first time they know they need to close a deal? If they get a deal, whether it's a wholesaler or, you know, whatever realtor that you work with, are you the first person they think of? You know, if I need somebody to close this transaction, close it fast, close it on time, and do not hassle me. Are you the first person they think of? Because I'll tell you, the brokers in our space, we're the first person they think of. And so that means I have to be ready to close, ready to buy the moment my phone rings.
Within our box.
Exactly, within our buy box, and it's small. It's a very small buy box. We're experts in, and you think, oh, mortgage notes, like it's just a mortgage note. No, it's not. We only buy very specific types of mortgages. And so our buy box is super, super small. And the brokers in our space and the people we know that sell know that if they've got something that fits in our box, we're gonna buy it, we're gonna close quickly, we're gonna close every time, we're gonna pay market price. And in order to keep that reputation, we've got to always be ready to close.
Yeah. And as we're working acquisitions, we have a funnel built for capital raise efforts and, CRM system. I know you were going there, Taylor, right? So keep everything on track. And, we use HubSpot. It's free. However, there are some upgrade features that are really kind of neat. However, for the purposes of our conversation here, we have everyone in our CRM system. We track folks with notes, track emails and phone calls and things like that. And we have a funnel set up in HubSpot where we run people through different stages. So if someone is in our pipeline, they're generally someone that has some level of interest in Bequest funds. And once we get a soft commit, then we move them into the soft commit section. And from there, once we send out the PPM, once we get the accredited verification letter, then we move them into a different phase of soft commit. And then from there, we move them to the closed phase for that month. So we're constantly, updating where we're at in each of the phases of the funnel. And, that's something that we talk about with our whole team on a daily basis, and it's posted up in the office for everyone to see. So it's very visible. We're very transparent. I know that word transparent is kind of thrown out there a lot, but we are truly transparent. You walk around our office, you see on a big screen where everything is at. All our whole portfolio, capital raise, acquisitions. I mean, everything is up there for the world to see, and we want it that way. We want everyone to know where everyone's at. We want to know everyone to know what the company's doing, and it breeds accountability for us.
Yeah, and capital raising will always be a one-on-one type relationship, right? People want to get to know Martin and I, and that's never going to change. And so you're like, well, how can I scale something when I can't duplicate the fund operators, right? But the reality is there's parts of the business that you can, create automation around that you can't. Getting your message, getting your brand out there with a lot of technology today, you can scale that. But there comes to a point where people hear from Martin and I, they need to know that we're trustworthy people, that we know what we're doing, and we're going to protect their capital. And they need to hear it from us, and they need to hear it from you if you're out raising capital. They need to know who you are, be able to, reputation. And make sure that you're an expert in your field. They have to be able to attest to that. And so raising capital will always be a relationship-based effort, something that, Martin debates. But there are things that you can do to kind of automate some of that. And that's more around branding and messaging, getting people into your network. Can be done through a scale, but to close people and to really bring people into your fund and sign the PPN, wire funds to you and trust you and send you more money, that requires a relationship. You just can't duplicate that.
Yeah, second money is easier, much easier to get. Once they've, the trust is earned, that's without saying. However, when you mentioned that you're building your network, you have to be pruning always, right? Jim Rohn talks about pruning the bushes, and that's so incredibly significant. So there's so many people that one can talk to during the day that they have no business talking to, like those individuals outside family and your children and your wife or husband. There's a lot of people that you can do your best served not spending time with them, and the less time you spend, the more profitable you'll be, because they're not leading you towards your goals, and you're not leading them towards their goals, on the flip side. So it can be very two-sided. But pruning the bushes, figuring out who's not in your investor profile and kicking them out of the CRM system is critical. Doing the same from a seller perspective on the acquisition side. So there should be ongoing pruning without a doubt. Otherwise, you'll just never get a concentrated mix of people that you want to see.
Yeah, we're constantly making sure that the people who are coming into our network are truly interested in our product and are not wasting our time, as Martin mentioned. And we first tapped into some tools to bring people our way, and we quickly realized our phone was ringing a lot. We were on the phone all the time. These people were not buying our product.
Horrible. They call during dinner and all that. And
Well, you'll learn. You're selling a product. We're selling a product, and every cycle that you generate, every effort you put in, you need to see a return on, or you need to step back and draw up a new plan, a new massive action plan, because the plan you have in place, that map that Martin talked about, is not producing the result you anticipated. And so, yeah, we definitely made some mistakes along the way early, spinning out like a hamster wheel. We were running really fast, but not going anywhere.
Marketing to people we shouldn't have been marketing to, spending time with people we shouldn't have been spending time with. Yeah, in summary of what you're saying.
Yeah.
Yeah, absolutely. So you kind of learn, as you learn your investor profile, you learn, that kind of helps you with your strategy.
It sounded great when we put it together.
Yeah, because you're thinking numbers game, right? Throw a bunch of numbers in the funnel, and the more you throw in, the better the results, or the larger the quantity of the results, or what have you.
So what was that
Taylor,
big
anything?
change? What was that big change that you made? I feel like I don't really have a great feel for, you're getting the wrong type of leads, and then you figured it out, made a change, and then you're getting the right type of leads now.
Yeah, so we wanted passive investors. We want people to set it and forget it. They put 100,000 in, and they're going to get monthly payments for the rest of their life, and they never have to think or worry about how the operation's going. What's the nuts and bolts of it all. So that's really the core of the investor that we're looking at. However, initially we went after, and we met with a lot of real estate investors that wanted to dabble in notes, and so they wanted to understand, they wanted to peek under the hood. They wanted to create unnecessary, hindrances around what we do, and just kind of it was disruptive to our process. They wanted more yields. They wanted to cut deals with us as real estate folks and we're real estate folks too,
right.
So we get it. But they want to cut deals. They want to go optimize, return on capital and all this and that. But that's not who we learn. That's just not who we're not their guy at that. We are your guy if you're looking at 8% return, paid monthly, consistent capital preservation in place, backed by the U.S. real estate market, and managed by an experienced group of fund operators. So that's really where we're your guy. So we learned to say, hey, look, we learned to determine up front, are we a good fit? That's really what we're very concerned about when we talk to people. Are we a good fit for each other?
Yeah. And early on, we also hired a marketing firm that would just get people on the phone who were potentially interested in your product. They really knew nothing about you. They picked up the phone, and they, a one-liner got them not to hang up. And then they would hand the call off to Martin and I, where we would give a 30-second elevator pitch. And honestly, it's not a bad way to market. The problem is it took so much of our time. We could do that through so many other forms of media. We could get the message out, get people interested, without Martin and I actually having to be on the phone with people who really aren't ready to buy now, but will do research on us and may buy in 6 months. And so we realized that, it doesn't require our effort, on the phone all day long to get that person, just into our network, right? We could use other tools to get people in. It didn't require us to be on the phone. And so we learned early on how valuable our time is, and that we could use it in much more powerful ways, other than just talking to people one-on-one when they really didn't know anything about us, weren't technically interested in our product just yet.
And I'll give you the flip side to that. But I'll just first say, today we signed on a company, a mid-sized company that has an employee savings plan trust in place. So that's a good, so it doesn't have to be necessarily an individual, but we have now our first company that's signing on with Bequest Funds, which is kind of neat because there's high expectations for them being long strategic partners. But what I'll say on the other side is that your massive action plan may lead you to want a capital partner that would be the exact opposite of what we're describing as the perfect capital partner. So you can't have a one size, fits all. There's a lot of real estate investors, and there's a lot of note investors that actually seek out money from their Aunt Sally or their mom and dad because they don't want to be bothered. They want that passive money so they can go out and do what they want to do with it. However, those individuals, and they may be on the newer side, they actually should be looking to seek out capital contributions from an experienced real estate investor. They could bring some capital, but also expertise from an underwriting standpoint, from a logistics, asset turnover, repositioning standpoint, and all that thing. So they should be looking for that. They should be looking for a hands-on investor, even though that may seem like a nuisance up front. That may be a good education that they could be getting from that investor.
Yeah, I would agree. I mean, think of the people around you who can help you, right? With your, I mean, I could never have built this fund without Martin's help, right? And so I knew that I had skill sets. He could have probably replaced my skill sets with somebody else, but I knew together.
But the humor wouldn't have been there.
Yeah, no, the humor wouldn't have been there. But together, we both had the right skill sets to actually take this thing, put an action plan in and build it and grow it, and hopefully one day hand this company down to the next generation, our children. And so, I was, thought I had all the skills that I needed to build this one day myself, and I realized that I couldn't do this by myself. I had to find somebody that had some other skills that if I paired my skills with together, we were going to build something great.
Yeah, I would say likewise. I've had I've been an entrepreneur since 2004. So, however, I have never moved as fast as I have in the past few years. So same with Sean. So finding good strategic partners, finding good capital partners, but it comes down to knowing your strengths and weaknesses, like Sean kind of touched on. And if you don't do that first self-assessment, then you're never going to know who you need to find when you're out on the dating scene looking for capital partners or strategic partners. You're not going to know, because you want people to offset your weaknesses while you offset their weaknesses. And that's really where the best partnerships are made.
Nice. We did have a question come in through the chat. I'm going to read it off here and see if you guys can address it. So given the desired investor profile you're seeking, how can new investors expect to do their due diligence, their initial due diligence? And then how about ongoing due diligence? Like, how are people looking into you and evaluating your fund, and what can they expect to be provided? So this is kind of coming in from a passive investing type of question.
Yeah, I would just say first, and I'll let Sean kick in. I would just say first that they have to meet the basic requirements to be considered as an investor before we're even going down this funnel road, if you will. So are they accredited, and are they seeking cash flow, a cash flowing investment? If those two answers are yes, then we need to get them all the information they need so that we can have a consultation with them. Either we have an investment relations person in the office, either with them to do an initial consultation or to talk to Sean and myself, where we can further evaluate if it's a good fit for both sides.
Yeah.
And so I think that if you just keep it that simple, that's where, but you have to have a few criteria, a few pieces of criteria before someone makes it to you to spend your time while you're also spending their time, so you're not wasting time.
And Tanner, was the question about how people run due diligence on us as fund operators, or how we assess people who are coming to invest with us?
So I think the question is, how do investors run due diligence on you? And I'm personally certainly interested on hearing your end. I think
perfect. Yeah. So it helps when I have a business partner who's written numerous books on the topic we actually operate a fund on. And so, you need to establish credibility in that space first. Martin has done that through writing books, but that's not the only way to establish credibility and reputation in the space. But it does help if you are an expert. In fact, the business that you operate in. I mean, you need to be an expert, and writing a book is a good way to tell the world you are in fact an expert in the space. And so investors can run due diligence on Martin and myself just by finding some content that we put on the internet, right? And so we're out there. We've got a social media presence on YouTube and LinkedIn, and people can see our experience and find videos on us. When I was an early investor in notes, there's a video on me that has gone fairly viral of my first note deal. And so people need to be able to do research on you and kind of understand to make sure you are who you say you are. There's a lot of, the reality is there's a lot of con artists out there. Anybody who watches TV will see a lot of people out there, and that's what we fight against on a daily basis. People think that we're just trying to rip people off, and in fact, we do have a real business. We have a real operation. We have real expertise in this space. And so people need to run due diligence on you, and you need to give them avenues in order to do that with.
And they can come in and, we always invite people in that are looking to invest or are invested with us, and they can come in and meet our team. We can show them financials. We can, spend time with them. We can show them industry accolades. I speak at various industry conferences, and just when you have that reputation in the space that's been cultivated over the years, people that are in that position, generally it's because, they have left a good taste in a lot of people's mouths in terms of how they've transacted, how they've done right by investors. Because, in this world where information is just out everywhere, it's easy to find if someone's operating on the shady side. But I'll say that it's con people. I think the world we live in right now is people are placing emphasis on marketing over operations, over being an expert operator. They want to be an expert brander, marketer, and just sell the idea that they're an operator more than they actually do an operation. Yeah. But if you come in our office, it will not take you but a nanosecond to understand, we have our shit together, and we have a whole team. They're all, we have a controller that can show you financials. We have a team of asset managers that can walk you through our portfolio. They talk to borrowers on a daily basis. And there's just a whole, intense operation that's going on here.
Yep. And so to answer the second part of that question, how do we communicate, ongoing to our investors to keep them engaged as to what we're doing? And so we do a lot of different things, right? It's very important for us to, and this is actually the best part. Our fund is operating fairly well, even through the pandemic. We're very happy with how the fund is performing. And so not a lot of folks can say that right now. But for us, we love the opportunity to communicate to our investors how we're doing it. So we do that on a quarterly basis. We write a letter to our investors, and every quarter it gets more and more impressive. The information that we're putting in there is, there's meatier stuff that we're putting in, and so we're always communicating on a quarterly basis to our investors, financials, what the acquisition team is doing, how the assets are performing.
We have we've hired a third party fund administrator, so they're a third party objective set of eyes. They have an online portal that they've created, so all our investors can log on and get 24/7 access to their financials for their investment. They get monthly statements with the monthly payments are ACH'd or wired to our investors, and they'll do year-end tax forms, and that's in addition to our quarterly letters, as well as our Christmas party, which is on December 12th for all our investors here in Sarasota. So there is an overwhelming abundance of communication and transparency with our company.
On top of the fact that it's, we feel the need to reach out to our investors every month or two just to kind of see how they're going, right? See how things are going. Making sure that we've got their address updated to make sure they're going to get their year-end tax statements on time. We're just in constant communication with folks, just to make sure that we want a family feel,
Yeah.
right? Martin and I launched the fund. We're like, we really want to make this a family feel type fund. And so that becomes harder and harder to do as we grow. But we've committed to making sure that we keep that small family feel. Where if any of our investors, they have our cell phone numbers. If they want to call us at any time, we always answer. We're always around.
I showed that company that's investing with their employee savings plan. I showed them the $1 million that we have invested in the fund. So I showed them confirmation that we're in the fund as Class B shareholders as well as themselves. So it's really as much you should be vetting where you're placing your money. I mean, that's absolutely the case, and that really should be the first question. How much money, how much skin in the game does the operator have?
The other thing that we're doing, and we're committed to doing this now that hopefully the pandemic is behind us, is we want to bring all of our investors together annually, one time, so that in a beautiful place like Sarasota, Florida, in the winter. And so we've already scheduled the December 12th.
Yeah, we got a private social club.
Private social club. We want all of our investors to know each other. We want to keep that family feel, and so we will be inviting everybody to come see us, come see our operation. There's a party already scheduled on December 12th of 2021. We want folks to come down here and visit us. We raise capital all across the U.S., so we're not necessarily raising capital just in our backyard here. We raise it all across the U.S. and we know that we'll be able to pack the room with folks, and so we want people to know who else is in the fund, who else is invested with them, alongside them.
Nice.
Yeah, family. I mean, how often, Taylor, do you see where operators that have a few different investors in the pot for that opportunity, and the operator never brings the co-investors together, so that there's no communication, and it may not be intentional. It just may be kind of how things are set up with that opportunity, or there may not be a real benefit that's perceived with bringing everyone together. But we want everyone to celebrate what Bequest is doing together as a family.
Awesome. Now we had one question come in about now I know we're not giving anybody tax advice, right? But how are returns are returns to investors treated as ordinary income or classified in some other way? One. And then two, is the trip on December 12th tax deductible against maybe just for you guys?
Well, actually, so you're gonna have to ask your CPA if the trip is tax deductible. But my wife is my CPA, so I would make sure that it's tax deductible for sure. But anyways, the fund earns income in two ways. The first way the fund earns income is by borrowers making their payments. And so borrowers make a interest payment and a principal payment to us. And so that's considered ordinary income for our investors. Another way that our fund produces income is through capital gains. We buy assets at a discount. We'll go out to the banks and we'll buy re-performing mortgages. And for those of you who don't know what those are mortgages that the terms have been modified at some point in the history since it was originated. And so we buy what we call scratch and dent mortgages that are performing directly from the banks. And so you say, well, why would a bank sell a re-performing mortgage? Well, because the regulators require them to over-capitalize those types of assets. So it's cheaper for them to get them off the books and sell them to guys like us. And so we only buy re-performing mortgages. We buy them at a discount. Since we buy them at a discount, what we find is people sell their properties, crazy. They refinance our debt out.
Our coupon's at 14%.
I don't know why they would refinance our debt.
We want them to keep it as long as possible.
Yeah. And so our borrowers sell the property, they refinance our debt, which means if we paid a discount, we on average pay about 65 cents on average for these assets. So if it was a $100,000 mortgage, it's kind of crazy, but we'll in fact pay $65,000 for that mortgage from a bank. It's a paying mortgage too, that has plenty of equity. But because it has that re-performing mortgage tag on it, the banks have to sell at a discount. So we'll buy it at a discount at 65 cents on the dollar. When a borrower sells the property or they refinance, we're owed that $100,000 on that note. And so that's a capital gain that comes into the fund. That capital gain is part of the income that our investors receive from us. And so on average, about 80% of the distributions down to our investor is ordinary income, and about 20% is a capital gain. And so whatever percentage the fund does overall at the end of the year, that's passed down to the investors. We pay an 8% return to our investors. And so a percentage of that 8% return will be capital gains, most likely long-term, and a percentage will be ordinary income. It's about an 80-20 split for us.
And we have a sample K1 that we can show that we had our CPA draft along with a letter of explanation. So if you want, just shoot me an email and I'll send it over to you. But I'll ask you if you're accredited first.
Nice. This is a whole other can of bees that we don't necessarily need to dive into, but you guys had mentioned way back at the beginning, I think even before we started recording, capital gains taxes might go up significantly. Does that impact, any of your plans on, how you plan to structure the fund or any of these deals? If capital gains, shoots up to closer to ordinary income for the average person out there?
Yeah, so since, as I mentioned, it's about 20% of the distribution down to our investors. And so today, the highest tax bracket in capital gains is 20% for the highest wage earners. we anticipate, if the new administration gets their way, it could be, they could impact long-term capital gains up to 38%. Because it's such a small portion of the distributions that we make to our investors, it's not really going to make an investor, make a buy and no buy decision on the fund. And so for us, it's not a major impact. But on the buy side for us, it will impact us, because a lot of other funds who have bought assets maybe at a discount, even more so than what we buy at 65, they may have bought at 30 cents on the dollar when there was no equity covering these loans, and now all of a sudden they have this equity, and if they sell it in 2022 versus 2021, that could be an 18% difference in taxes. We are anticipating a lot of folks that we trade with will in fact unload assets for us. We can buy those assets, likely at the rates that we need to get them at. We'll see a lot of folks, the hedge funds, unload assets this year that will pick up, that we're not worried about the tax consequence to it, because we're in it for the long haul. Whereas other folks that are in our space would in fact, save 18% if in fact they unloaded it here in 2021. And so we don't really see much on the investor side. We don't see that it's going to impact our investors much, since it's
going to drive people into our fund.
Yeah.
I mean, capital gain investors, where are they going to go? So it's just, yeah,
people who sell in 2021 to take advantage of any potential tax savings this year, gonna need a place to put that capital too on top of that. So we're seeing a lot of folks, get prepared to reset the clock on a lot of money. And so they see the fund as a place to do that. And we see it as an opportunity with capital gains going up for us to buy assets from other hedge funds. So we don't really see it impacting our investors much at all.
Gotcha. Okay. Now I had one question, private message to me here, literally just like 15 seconds ago. So this person whose name I'm not going to say says 8% sounds too good to be true. And if it was really, that great, everybody would be doing this. Can you give like an example of what that return looks like?
You need to lower it. I told it should be at 6%. This is probably the last year we're doing 8%. We're creating a Class C. We need a Class C now.
So everybody, we buy mortgages, right? So the first question we always get, like, Sean, you're buying a mortgage. You just said you bought $100,000 mortgage, and it likely pays a 6 or 7% coupon. How in the world are you turning around, taking investor capital, buying that mortgage, and then paying out an 8% return? You're not making any money. Well, what's actually happening is we're buying this asset as a discount, right? We're buying it as a discount. And so yes, banks are selling loans at a discount, because it's not 100% perfect paper, right? It can't go into the bond categories that they normally, like, the Fed is buying a lot of mortgage-backed securities that are A-class rated paper. Well, we're buying paper from the banks that don't fit in that category, right? And so what happened is the borrower had a challenge at some point since the loan originated. The terms had to be changed. The interest rate had to be lowered. The payment terms had to be changed, lowered. The schedule had to be lengthened in order to keep the homeowner in their home. The terms had to be modified. Those are the assets that we buy from the banks, right? And so banks have to sell those at a discount because the terms were in fact modified. And so we're buying those assets at a 65% discount on average. We're paying about 65 cents on the dollar for those loans. There is a higher default rate for those types of loans. It's likely 10%. Martin and I have experience in loss mitigation. We used to buy non-performing mortgage paper. That's how we got our roots. We know how to. We still do. We still do. On the other side, we still do buy non-performing paper, not in this fund, but in another business that we operate. So we know how to get mortgages re-performing again, right? Because of the higher default rate, banks are selling these at 65 cents on the dollar. We're buying these assets. These assets are producing between a 12 and a 14% yield when we buy them. We're able to pay out an 8% return. The fund produces about 12% overall. We're able to keep 4% to operate the fund. And so that's how we're able to produce an 8% return, because we're buying mortgages at a discount from the banks, scratch and dent mortgages. The underwriting criteria is still very solid. If I took you through how we underwrite a loan through our non-performing lens, it would all make sense.
It would look very similar to how the originator who runs through due diligence, title reports, credit pulls, background skip tracing, credit risk assessments, equity coverage, all of that.
So yeah, so we're able to buy assets at a discount that produce about a 12, 13, 14% yield. Our team keeps those assets performing, and we're paying out an 8% return to our investors on a monthly basis. It's an annual 8% return. We're making monthly payments to our investors. We're collecting monthly payments from our borrowers. We're paying out to our investors. And because paper is liquid, we only require folks to be in the fund a year. So it's only a year lock period.
Okay. So if somebody invests, say, $100,000 in that first year, over the course of a year, they're going to get $8,000 back as a return.
Absolutely.
Cool. Well, I think that has pretty much covered most of the questions that we had. I think we're also about 10 of 8 o'clock. So you guys have been with us quite a while tonight. Haven't been sent any additional questions. Appreciate you guys joining us and burning the midnight oil. The sun was not quite set over there on the beach when we first started. Now it's all completely set. So
hey,
thanks for joining.
On Taylor.
Yeah.
What you're doing a great job, getting your message out there, getting all the podcasts out there. So
well, thank you very much.
Keep up the good work.
Thank you. And I appreciate all the lessons. Like I said, this is recorded, so I'll send you guys the recording after we're done and it's all finished and everything. And thanks everybody for joining us. And we'll see you next month with our next meetup.
Yep. Hey, Taylor, so if someone wants to reach out, they can go to
sure.
Martin
Sorry.
No, that's fine. They can go to martin@bqfunds.com, or they can visit, if they want to learn more about note investing in general, they can go to noteinvestingmadeeasier.com.
There I'm looking like a rank amateur. I never forget that on my show, and I'm forgetting that here. I apologize. bqfunds.com, martin@bqfunds.com. And thanks once again, guys.
Thank you.
Bye-bye.